That is my official disclaimer, and basically I just want you guys to know that you can't sue me when you try to put my penny stock recommendations into play. In all seriousness, I won't be making any penny stock recommendations, and I should let you guys know I'm just a business teacher that gets an unusual amount of happiness from reading business and finance books. I don't have 13 letters after my name. I don't have any financial credentials of any sort. I don't want to scare you off by that. I can assure you that many people with many financial credentials have very little actual support to give you. But just so you know, buyer beware on this one. Don't take my word for it. Ask around. Do your own research. No one should care about your money more than you do. So, on that note, so who the heck is this guy? I'm Kyle Prevost. I've written for Canadian MoneySaver on several occasions, in addition to my blog over at youngandthrifty.ca. You might recognize the random ramblings of my voice from some CBC work I've done, and you may, if you head on over to the website, see something similar to something you've read in one of the financial nerd hangouts like the Globe and Mail and the Post, something like that. So, if you came here tonight, you might be wondering, am I in the right place? So look, I don't want to scare anyone away here, but if you're one of these folks that's been a long-time CMS subscriber and you want to debate the finer points of price-to-earnings ratios and momentum investing and value investing and all these different things, this might not be the spot for you. I fully recommend you stay, whether it's just to grab some information to compare to what you're doing, whether it's to recommend it to someone else, anything like that. But just keep in mind that this webinar is going to be aimed at folks that are generally just getting in, just getting their feet wet, looking for something relatively quick and easy, relative, of course, to doing hours and hours of research. So if doing hours and hours of research is your thing, great. But just keep in mind that you probably won't be the target audience tonight. So if this is you, if you're just getting started, you've woken up to the world that mutual funds are, how to put this mildly, garbage, especially in the Canadian setting, then this might be the spot for you. So what we're going to do tonight is we're going to go over some of the sort of basics behind how I invest and the fundamentals behind my investing philosophy, and then we're going to get into sort of the step-by-step, the nuts and bolts of how you can actually get your paycheck into your investment portfolio, and how to do that along with all these acronyms and all these other things. And what I have found has worked best for the normal people, the non-financial bloggers that I know, and sort of why we've seen higher levels of take-up and success with certain strategies. Alrighty, so listen, I'm a teacher by day, like I said, so hearing the sound of my own voice isn't totally new, but it gets boring in a hurry, I can assure you. So if you have any questions, throw them up here. I think I'm handling this whole question screen properly. You can also tweet them. I'm not sure we'll get to them during the actual webinar, unless it's at the very end. So if you tweet something to Lana at Canadian MoneySaver, we'll get to it at the end of the show. You can also tweet to our Twitter handle at Young and Thrifty, and I'll try to get to that when we're all wrapped up as well, just to keep things kind of simple here from a visual perspective. I won't throw it back and forth to my Twitter handle during the show. But I would like you guys to ask any questions if you have them, and don't leave here tonight before you get your question answered. All right, so first and foremost, why bother with any of this stuff? And the reason you should bother with any of this is because you one day would hopefully like to reach financial independence. To some people that means retire. To some people it just means having quote-unquote FU money. If you want to tell your boss that you're done, you can do that. But first and foremost, I think the reason that you should want to do this is because you work hard for your money, and you want that money working even harder for you. A popular phrase is that it's not timing the markets that's important. It's not choosing the highs and lows. It's your time in the market. So it's not necessarily about buying low and selling high. It's actually more about how many years can you actually invest for. And so that's why this webinar is going to be sort of focused in on what are the easiest, the quickest, most efficient ways to get your money into the market and get this power of compound interest working for you. when I teach personal finance to my grade 10, 11, 12 students, I like to start the year with just a very basic exercise, and it's called Retirement Up in Smoke. And what we do is we look at the price of a pack of cigarettes, and if you were to invest that much money or even half that much money and do it consistently, and if obviously you start at a young enough age, then you can make a heck of a difference in a hurry. Of course, some of my students choose to take that money out when they're 30 and buy a luxury vehicle. I guess that's a superior choice to smoking. However, probably if you clicked into this webinar, you're looking more at a long-term savings sort of thing. I got a question that just said, what is the chart they're assuming? You can head on over to the link there at the bottom if you're truly interested in that chart. It's assuming a 6% return rate. It's not overly aggressive. Basically, I just wanted to show you guys the difference when you started investing there. All right, so here's what I get a lot from folks that like to read financial magazines and read financial books when they tune in or read one of my podcasts and then send me an email or listen to one of my podcasts or read a blog post. These folks are very driven individuals and they want to get the most for their money, but the problem is they end up sort of with a paralysis by analysis, and what that means is they tend to want to read just a few more books, or they want to wait till the market takes just that little bit of a dip, or maybe we're in a bubble, or maybe we don't know, the market might be down and you don't want to catch a falling knife, and they hear all these other weird cliches from 24/7 business news channels, and it doesn't actually have to be this hard. I'm not saying there's zero value in a 24/7 business news channel, but I'm saying they probably do more damage than good from pretty much every study I've read. So instead of being obsessed with returns and beating the market, you should know that that's not actually the determining factor of wealth in most cases. Your idea is savings rate and your time in the market, and then your basic diversification. That's pretty consistent across every academic study I've read, that those are your main factors in terms of building wealth and building success for financial independence. So just a quick review, if you're not familiar with the traditional model of financial advice in Canada and across much of the Western world, the idea is that a well-dressed, usually man, but sometimes female, talks to you and says, no worries, I'm going to give you the keys to happiness for free. You don't pay me anything up front. You'll never write me a check. And I'm going to give you financial advice. I'll be your best friend. Now let's talk about what investments you need. And of course, that's a very backwards way of doing financial planning. Like really, you shouldn't be starting with investments, sometimes very risky investment planning. You should probably be starting with some basics on risk tolerance and income and all these things. Now, keep in mind, I'm not saying at all that there are no good financial advisors out there. I'm not saying that at all. But what I am saying, without a shadow of a doubt, is that we have had an incentive in this country from financial advisors to sell products that are not necessarily in the best interests of the people that they're buying them for. And those products, more often than not, are mutual funds. And we have amongst the highest mutual fund fees in the world here in Canada. So I'm not saying, I want to make this clear, I'm not saying that there's no good financial advisors out there. And we're going to get into this later in the show here about how to identify, how I feel you can identify a good advisor up front. What I am saying is that the traditional model of investing in this country, especially low maintenance investing, was very broken and has been broken for a long time. We're seeing some light at the end of the tunnel, so to speak, right now. But the way that the vast majority of Canadians have invested their money and gotten advice for investing their money has been quite poor. And when you sort of combine that with the severe financial literacy in Canada, you've gotten a very subpar overall set of outcomes that we hope to improve here. So here's a quick look at the current Canadian market. So the ETFs, according to the Financial Post link there, they're looking at right around $100 billion Canadian in terms of assets under management as a group in Canada. Obviously, that's not chump change, but when you compare it to the huge amount of money in mutual funds, yeah, I don't know what to say beyond that, and especially when you consider how high the fees are on most of Canada's mutual fund products, especially into equity mutual funds. And I'm convinced this is a terrible idea for many reasons that we're going to get to here. I just wanted to sort of set the table as to what most people see as the investment industry in Canada. All right, so you know, if you're not familiar with some of these studies, you can check out my free ebook located at Young and Thrifty there, and it has, I've just pulled a couple of excerpts from it here, but basically, long story short, I'm convinced that mutual fund and mutual fund managers, by and large, are full of it. I don't believe that they beat the average, and I don't really see a whole lot of evidence that they do. Oh, sorry. And so you say to yourself, well, if mutual funds are that bad, Kyle, how come generations of Canadians at this point have invested in them? And my response is simply that it's amazing what people will believe if they're paid to believe it. And I talk to financial advisors, I would say almost weekly, that are vehement. They will argue with me till they're red in the face that the current model is excellent. Why are we messing with it? People under the current model do way better. And then they quote me some statistics where they mix up causation for correlation, and we do that whole song and dance. But, you know, we'll get to that. I just believe an incentive structure that ties financial advice to the management investment fees in mutual funds is a bad omen. That's not, it's putting the incentives, it's misaligning the incentives of the financial advisor with the sort of benefits of the person they're advising. So if not mutual funds, we must be picking stocks, right? I mean, if not one, then the other. So I'm just going to go over here my feelings towards stock investing. And now I should point out these are contrary, maybe directly contrary, to some of the stuff that you will read in Canadian MoneySaver by certain authors. So I'm going to preface with that. Please do all your own reading, make your own decisions for yourself, but you guys already know that because you're a smart, educated audience. Every time you buy or sell a stock, keep in mind that there's someone else at the other end of that transaction, and they think they got the better end of that deal. These days, more often than not, the person, quote unquote, at the other end of that trade is probably a computer algorithm. I'm not certain that many people, and certainly not myself, can beat a stock trading algorithm serviced by a supercomputer that was created by a group of hedge fund managers somewhere. That those guys probably should be, you know, putting people on Mars or, you know, solving huge engineering issues, and instead get paid quite a lot of money to figure out how to make sure that when their machines buy and sell millions of dollars worth of stock every day, that they get the better of you. So keep in mind, if you want to pick stocks, that's what you're going up against. I'm not saying that you can't beat that. I'm just saying that those are the folks that you're up against. A recent study from Morningstar, if you're not familiar, they're pretty much, I would say, the most widely used investment analysis website for mutual funds. And they stated the average stock investor trailed the average returns generated from the stock market by 24% from 2001 to 2011. You might ask yourself, how is that possible? The way averages work, how can an average investor should obviously get the average return? And the problem is that they don't stay in the market the whole time. They buy and sell at the worst times often, and then when you factor in the fees that they're paying, the person that's actually picking their own stocks generally doesn't do very well. And there's many studies out there. Feel free to Google them. This is just a quick one that I found. Basically, all that to say, picking stocks and waiting out the long term or sticking to your stock investment strategy when there's all this other noise in the background is very, very difficult and requires a substantial time commitment. Here's another quick one, another quick study that was done over 20 years. And obviously it's for an American audience, but I think it correlates pretty well here in Canada. And you can see that even though the economy in general, the large indice in general had a pretty good run, a lot of the folks that were picking stocks did not realize the full return or the average return. So if not mutual fund investing and we're not picking our own stocks, what are we left with? And this is my preferred solution for the vast majority of Canadians. Once again, just so I'm on board, just so everyone's on board here, I'm not saying that it's impossible to beat the market with certain strategies. I'm saying it's very, very difficult. And to be honest, in the long term, I'm not sure that any current strategy will continue to outperform the market just because of how averages work and how competitive the financial industry is. So I think I got a lot of academics on my side. I think I got a lot of smart people on my side when I say that index investing is the go-to for the average Canadian right now. And sort of index investing now has evolved where there's a lot of different names and a lot of different platforms and a lot of different ways to do this. So these things are not all exactly the same, but they're similar terms for what I'm about to describe. So index investing, a lot of folks now refer to it as couch potato investing. You'll see I've got an ebook out called Keeping It Simple with ETF Investing. We're going to talk about Robo Advising tonight. You might be familiar with the TDE series platform of investments, or perhaps even the Tangerine Turnkey portfolios that were introduced a few years ago. The basic idea here is that you're going to take the market average. You can do quite a lot of reading on this. I'm not going to go to it super in depth, but suffice it to say that all of these different platforms are based on folks that won Nobel Prizes rather. I would Google John Bogle and Eugene Fama specifically, and basically what they're going to tell you is that you as an investor, if you can get the market average and just trim the fees to the absolute minimum, you're going to do pretty well. And you're going to do great if you can ignore all this buy and sell noise that people are shouting at you and the stuff about bubbles and bulls and bears and all these different things, these ridiculous cliches that the talking heads like to throw out at you. If you can ignore all that and just stay invested in the biggest companies from all around the world, and you know the best mix of bonds from all around the world, and just readjust your sort of readjust your portfolio as you go, that will be for the best. I'm just having trouble here bringing up the question screen, so bear with me. Give me 2 seconds while I try to figure out. I just don't want to miss anyone's questions.
Hi, Kyle. Are you okay?
I'm with you here. I just want. Got it. I am able to pull questions up. Thank you.
You're good to go.
All right, and I have not missed any.
All
so
right.
we're ready to rock and roll.
All right.
All right. So the real question here then is, if you subscribe to my idea of index investing, how lazy do you want to be? How do you actually want to put these ideas into practice? If I've convinced you, or your reading has convinced you that index investing is the way to go, how do we actually get about doing that? So we talked a little bit about the fact that you're not going to be trying to pick stocks. You're just trying to quickly and easily diversify your money. Basically, you're trying to get the same diversification that mutual funds have promised you, just doing it way more efficiently and, frankly, much more profitably than mutual funds have. But when it comes to picking the platform, what we're going to be looking at is the time and effort versus the higher fees. So where do you fall on this spectrum is going to be the focus of pretty much the rest of this webinar, and I can answer any questions you have about the various platforms that all use index investing. So that's key to understand that I'm not talking about picking stocks here. I'm not talking about picking funds that are going to beat the average. I'm actually just talking about which preferred platform or which platform might fit you best if you'd like to go the index investing route and be a couch potato like I am. So quick reminder before you look at all these, each of these options has lower fees than the traditional advisor plus mutual fund model. The difference in fees between the different things we're going to talk about is substantial, but if you never get into the market because you're always looking for the best way or the easiest way to trim fees and you constantly are reading and doing things, that opportunity cost of not putting your money into an investment portfolio is actually going to be worse or is actually going to be more substantial than the difference in fees between our options. So 2 quick things: they're all better than the traditional method, and don't let a few percentage, tenths of a percentage point keep you from not investing at all. So You want the ultimate and low-cost options. This is a lot of what I talked about a year ago on a Canadian MoneySaver webinar. The ultimate and low-cost options is you're going to pick ETFs that follow underlying indexes. You can go to my website and see what I recommend. A guy who's got a great book out about it, John Robertson, The Value of Simple. He's also a big fan of this. He gives a step-by-step guide, in addition to what I have on my site, on how to set up a discount brokerage and purchase specific ETFs, how to rebalance them, some different things you might want to take into consideration. And essentially what you're going to do is you're going to figure out the best portfolio for yourself of picking the best, or the what percentage of Canadian stocks you want to have, what percentage of American stocks you want to have, and then any other additions, and then what part of your portfolio you want in bonds, and then you're going to purchase those ETFs, and every month or every 3 months or every year, depending on just how couch potato you want to get, you're going to rebalance those portfolios on your own. It's relatively simple. It's relatively easy once you do some reading on it. Now that being said, I know a lot of Canadians, I think the vast majority of Canadians do not want to do a lot of reading. They don't want to spend even 5 to 10 hours on this every year. And Linda here has asked a quick question, and she's basically pinpointed the exact question that this webinar is going to seek to answer. She said, is it more efficient to invest as much time and research as possible to be able to pay the bare minimum fees, or is it better to find a happy medium or some combination of both? And that's up to you, Linda. What I'm hoping to do tonight is give you the details so you can make that choice for yourself. I will say this, and I'm going to probably repeat this again later in the webinar. In my experience trying to help people with their finances over the last 5 or 6 years, I had initially underestimated the barrier to entry that this reading represented. And I've come to appreciate the value of simplicity, and I've come to appreciate sort of a middle ground between cutting fees and just getting people into it and letting them get on with other parts of their life. All right, I'm not going to spend too much time on the TDE series and the Tangerine Turnkey portfolios tonight. They were previously great platforms for folks that wanted to invest a little bit of money each month without paying the fees associated with a discount brokerage. So in other words, if I was only going to put in a couple $100 a month into my investment portfolio and I wanted to do that monthly, it may have made more sense for me to do so with a TDE series fund or a Tangerine Turnkey portfolio fund. Frankly, I believe that either the ETF sort of approach that I briefly outlined there, or the Robo Advisor approach that I'm going to get to right away, are both superior options. So feel free, I've reviewed both of these on my website, feel free to Google them. They both use index investing. They're not bad. If you already bank with TD or you bank with Tangerine, perhaps the utility of them will be maximized, since it should be quick and easy for you to transfer money from an account to the platform. But that's about all I'm going to say for those guys. They used to be market leaders. I would not recommend them currently to anyone that wasn't with those institutions already. All right, so the solution for most of us, and I think you know, one of the real pluses over the last 10 years in sort of the industry, and it's been going for quite a long time in the States, and it's finally got up to us here in Canada, is Robo Advisors. And this is the solution that I recommend to 80 to 90% of my friends right now, my millennial friends specifically. And essentially, if you just want a super simple way to get a chunk of your paycheck into your investment portfolio, and you want a super simple investment method that you can understand, then I believe a Robo Advisor might be best for you. And I'm going to tell you why, and I'm going to stay away from recommending any one specific Robo Advisor. I want to focus on the benefits of them as an overall group tonight. If you want, you can head on over to my blog at that link right there, and you can read a pretty thorough review of sort of the market leaders right now, as well as any questions you have on Robo Advisors. So if Robo Advisors are not robots, then what are they? You're going to have humans that you're going to interact with Robo Advisors. The only thing that is going to be handled automatically or quote-unquote robotically is when you put your investment money in, before that happens, you will have met with a robo advisor and you will have agreed on a specific index investing path you want to go down. Say, I want 20% of my portfolio in U.S. stocks and 10% in international stocks and 20% in Canadian stocks and 50% bonds. So in other words, 50% diverse equities and 50% bonds. I'm a relatively conservative person. That's what I want in my portfolio. So when you throw your $200 in there, it will automatically go into those previous percentages that you have outlined and agreed on with your advisor, and you can change those at any time. Just talk to them. They'll get it all set up. And this is consistent across all the different robo-advisors that I've looked at least, including the market leaders. So there's nothing robotic about the actual advice that's given, and you can talk. There's a bunch of different ways to talk to these folks that are on the other end of the computer at any point in the process. So you're going to be able to interact with a human being that can answer your questions. I had a quick couple of questions here before we move on, just talking about with discount brokerages I recommend. And are there any that don't charge reoccurring fees if you don't meet a minimum balance? Head on over to my blog if you want the answer to that. I don't want to throw out specific discount brokerages, frankly, because none of them have paid for the privilege of being on this webinar, and they can do so. They can talk to Canadian MoneySaver if they would like to go that route. But if you head on over to and grab my free ebook, I can tell you which one I use specifically and what their fee schedule is. And Hassan, you wanted a link in the chat area. Head on over to my Twitter or wait after the show here when I got some free hands, and I'll get that link to you. Now, back to robos. So, if not robos, then we talked about that there are going to be humans. If you want to Skype with them, they'll Skype with you. If you want to chat with them, they'll chat with you. They'll return emails. These guys are meant to interact with you on an online setting. However, you probably won't be meeting with them face-to-face. Now, for me personally, that's a positive. I like to interact from behind my computer. It's very flexible. It fits my lifestyle. If I'm waiting in line somewhere, I can type a question, and they can get back to me instantly. If I email them, they can get back to me at their leisure, and we can go back and forth like that. I don't have to meet someone face-to-face. In fact, I'd rather not. If you want to do the face-to-face thing and not even Skype works for you, you can try, especially if you're in the Toronto or Vancouver area, and find a robo-advisor that may meet with you face-to-face, but that's not what they're designed for. So for me, they actually fit my lifestyle better than a face-to-face person. All this to say, there's lots of different ways to get in touch with a smart human being if you want to. So what do robo-advisors all offer? Why are they better than sort of these other investment options that I've outlined, or why do I recommend them so heavily to so many Canadians? The first answer is that they're much better investing options than mutual funds. They're all various different types of index investing. Depending on which one you go with, they have slightly different takes on how to do index investing, but they're all going to be miles ahead of your average mutual fund, especially if you look over a 10 or 20, 30-year period. They're relatively cheap. They're not as cheap as ETFs, and you can make the comparison on your own. If you go to that link that I gave you, there's a great calculator. And again, I'll throw that link up there at the end on Robo Advisors, and there's a calculator there that will compare the different robos and how much money you put into the portfolio and how much fees you'll pay. But usually you'll pay a little bit more than you will if you set up your own ETF portfolio, but substantially less than if you're using the traditional model. Perhaps the best reason is that it is the easiest way to invest that I know of. You can set up an automatic contribution scheme where every month your paycheck rolls into your bank account, and that slice that you want, that pay yourself 10% or pay yourself 15% or whatever method you subscribe to, that's going to go straight to your predefined investing portfolio. You can check on it whenever you want. And the robos, all of them across Canada are pushing each other right now, and their platforms are excellent. They're so easy to use. They're intuitive. You can use them on any device. They're colorful. They've got pretty good frequently asked question sections. They got great ways to interact. And so I think that really this is going to be the future for a lot of people that just want to sort of set and forget their investment portfolio, much as our parents and grandparents did with the traditional model. This is just going to be much more effective. We're not going to have to meet face to face with anyone, and frankly, we're going to get much better investment returns. Oh, and if you're wondering, one common question I get is, are Robo Advisors safe? Because they don't sound like you're talking about a robot investing my money. All the major robos are part of the CIPF, the Canadian Investment Protection Fund. And I've got, again, more details at the link. But suffice it to say, these guys are very safe. Their balance sheet for their company is separate from all of your investments. So if the company, for some reason, went down, your investments would still be fine. And to be honest, in that sort of scenario, they'd probably get bought out by a competitor. There's almost no circumstance where it would not be fine. So here comes the real question that I think probably most of you that are in this webinar probably want to know is, what sort of factors should you take into consideration if you're looking at a do-it-yourself ETF option or a robo-advisor? So I've outlined a few questions here for you that you should seriously ask yourself. And don't be honest with yourself when you say this. The comparison that I make for myself is that I continue to do it myself with a discount brokerage. I'm with one of the discount brokerages that offers free ETF purchases now. So the fees are pretty much nil for me. But that being said, when I compare this to my attempts to use the gym on a consistent basis, the availability of the gym, the ease of use of the gym and the facility, and basically how convenient it is for me to get to, are going to make a huge difference. I don't know why, that's just me. I'm motivated, and this investing stuff comes fairly intuitively to me at this point, and I'm just a geek, I suppose. But the gym stuff requires a little more mental effort on my part, and much like every study I've read, my success rate at going to the gym and getting in a good workout on a daily basis really depends on the ease of use for me. So if you can seriously answer these questions and follow this flow chart, then you'll realize that probably most people, and I'm not sure if it's most people on this webinar, but most people in general are better off going with a robo-advisor. So if you want to recommend something to a friend, if you're checking out this webinar maybe on behalf of somebody else, I would seriously consider a robo. If you want to put in that effort, you want to put in some time, you want to put in a little bit of reading and cut your fees to the absolute minimum, you're going to want to go with the do-it-yourself option. So we talked a little earlier in the show there about sort of the traditional model and the drawbacks that I saw with it in terms of financial advice in Canada. I continue to believe that no one should care as much about your money as much as you do, and whether that means reading or that means you know, checking out and rebalancing. And in fact, I just had a question on what basis I'm recommending 4 to 12 rebalancing periods every year. It really depends, Laszlo, I hope I'm pronouncing that correctly. It really depends on just how active you want to be. There's some folks that recommend rebalancing every quarter, and various academics have done different studies on this where they've seen increased results, especially if you're trying to diversify between multiple different asset classes. And some folks recommend once a year, just in terms of sticking with the strategy and minimizing effort, maximizing the couch potato sort of mantra. So it's up to you. You certainly could do it once a year. You certainly could do it quarterly, every 6 months. But generally, I've seen it recommended quarterly or monthly, where you rebalance, especially now that with discount brokerages allowing you to purchase ETFs for free. But that's getting into the nitty-gritty a little bit. So when we compare versus Robo, and we're looking at you know, who to go with and what sort of advice to get, I continue to recommend Robos. But a nice little pairing is fee-only advice. And I think you're going to see more and more of this going forward with something called CRM2 coming out. that's going to show Canadian investors exactly how much money they were paying in mutual funds. And I really like the idea of pairing a robo-advisor that's going to be able to answer the vast majority of your questions, especially if you're just starting out. They're going to be able to answer, I would say, 98% of your questions about, what is a TFSA? What does that even mean? What's the difference between a TFSA and an RSP? Or, what ETFs are in my portfolio? What are we dealing with? Here's a bunch of questions. What is my risk level? They're going to have folks that can answer that for you in those things. And Simon just asked, what is CRM2 and when will we see it? That's getting pretty into the minutia there, Simon. CRM2 has come into effect. You're going to see it in January. Basically, long story short, when you get your mutual fund or investment statement at the end of the year, it's no longer going to show some sort of 2% semi-meaningless number that no one can see. Instead, it's going to show a dollar figure in terms of how much money you actually paid for investment advice that year. So that you're going to see that, as far as I know, in January. I encourage you to just Google the phrase CRM2. You're going to see some stuff by Rob Carrick of the Globe and Mail, amongst others. You might even come across some Canadian MoneySaver articles, and you can educate yourself on that if you currently have money in mutual funds. You should know that when you're looking at advisors, almost all titles in the investing advising world are useless. And if you think that that's overstating the matter, I encourage you again to do your own research. Unfortunately, it's true. They don't mean anything. Almost anyone can call themselves a money coach, an advisor, excuse me, all these different things. It's not fair. There's currently a lot of people trying to sort of regulate this market a little bit, but right now the only real key term is fiduciary. And basically what a fiduciary means is that you are legally obligated to put your client's interest before your own, which means if you recommend investments that are too risky or carry too high fees for your client's risk profile, you can actually be sued for that. And you can end up with some pretty stiff penalties. So make sure that your advisor, if you choose to go the advising route, has a fiduciary obligation to you. Any fees that you're going to pay should be easy to understand. I hate the commissions game. We went over this earlier. I don't like it for selling insurance products. I don't like it for selling. I understand why it's an effective business model, but it's not something I'm ever going to trust my personal money to, nor would I recommend to anyone else. If you do need help, I like the idea of a fee-only advice. You go to a lawyer for lots of things in life and you say, how much will it cost to write up my will? The lawyer gives you a quote. Or if you say, if you go to a doctor or a dentist for a specific thing, obviously we have healthcare coverage for most things in Canada, they're going to give you an upfront quote on what you're going to pay. For some reason, we got away from that in the world of finance. I like the idea of an upfront agreement. Do you want a financial plan? The Robo Advisors might be able to help you with that, especially if you're a young person and your financial plan is fairly simple. Now, if you have some assets and you're looking into, some life planning strategies, if you're looking into, like, say, income trusts or I got here semi-exotic life insurance investing type of things, then you might want to look at purchasing outside help, specialist help. There's certain types of lawyers and tax accountants and different things like that that can sort of supplement or complement what a robo-advisor is doing for you. And I've recently found out, listening to Pre-Panergy's podcast, that a lot of fee-only advisors are actually using robos right now to handle all the investments of their clients. So essentially, they're going to the client and telling them, okay, so we're gonna handle your investments using the super simple strategy. Here's all the fees up front, and then we're gonna focus in, you and I, on setting up your life, whether it's budgeting, whether it's basic life insurance, and some other different specific planning that they're qualified to do. I think that's kind of a cool combination, and sort of I like that approach. So in conclusion, when you're looking at how lazy do you want to be, how much money do you want to pay on your investments, you need to get your money working for you as soon as possible. be honest with yourself. Don't tell yourself, yeah, I'm going to cut it to the bone. I'm going to read 10 books and then, okay, I'm going to read this summer. And then you get into work. I'm going to read it over the Christmas break, and you just don't quite get to it. Those of you that are asking questions, I'm just going to hold you off till the end now, and I promise I'll get to them at that point. Hopefully I've convinced you tonight. I only gave you a few select quotes, so you may not be totally convinced, but I think I can comfortably say that for 95% of us, the index investing couch potato strategy is the best path. Now, again, that's semi-controversial here at Canadian MoneySaver. There are folks that have put forward strategies, and they do have somewhat of a track record of beating the market in their specific instance. I know from the reading that I've done, the vast, vast majority of people do not beat the market. That index investing and couch potato investing is the best method of investing for the vast majority of people. It's very simple to understand, and you're going to outperform the vast majority of stock pickers and mutual funds in the market. Focus on cutting fees, whether that means cutting from a traditional advisor to a robo advisor or cutting to ETFs if you want the absolute minimum. That's the part of investing that you have control over. You, frankly, have no control over if the Canadian market's going up or down. You have no control over, how people perceive Brexit is going to affect the futures of the gold market or whatever the case may be. How locusts eating a crop in India are going to affect, the curry futures or whatever the case is. You see some crazy stuff on business news channels when you scroll through there. Or in the Globe and Mail and Financial Post, these guys that get paid to make these far-out predictions. Frankly, they usually have almost no idea what they're talking about, and they have certainly no control over what they're talking about. And the part of investing that you can actually control for yourself is how much money you pay for the advice and the investment product. Finally, decide where you fall on that ETF portfolio robo-advisor spectrum using the sort of quick and dirty rules of thumb that I've showed you here this evening. And finally, hit the couch, relax, enjoy as you watch the investment returns roll in. Focus on, your savings rate and sort of the lifestyle approach that you want to meet the goals that you have, that you've set up with your advisor, a robo-advisor, a fee-only advisor, and just ignore the noise in the market.